Hi. Before talking about large market participants, the logic of their conduct and the indicator based on their positions, I would like to tell you about the organization that collects information about large players. This is the Commodity Futures Trading Commission, or CFTC. This organization, which appeared in 1975, was created to protect all those who trade in financial markets from various possible frauds and abuses caused by certain market participants. In other words, the emergence of CFTC is a logical continuation of financial markets regulation that entered the active phase at the beginning of the last century. Financial markets have existed for a very long time, but the level of financial markets regulation in North America is perhaps one of the highest today. And the Commodity Futures Trading Commission, as well as its existence, and the information that we will analyze today proves this statement. We don't care about the Commission itself at the moment. I have mentioned it just to make it possible for you to understand where all that information which we are going to handle today comes from. Commission website is www.cftc.gov. The Commission site looks something like this, and if you want, you can learn more about it, read about this organization, and actually learn more about its activities. I won't dwell on this issue, since the functions of the Commission and its role in regulating financial markets are not the key issue on today's agenda. We are interested as far as possible in the reports published by this Commission. The reports are called COT reports. They can be found on the Commission's website, and they are updated once a week. The Commission publishes these reports based on statistics of market participants' activities and sorts these statistics according to the group to which one or another market participant can be attributed depending on certain transactions made in the reporting period. This report is updated on the Commission's website every week. By the way, you can subscribe to a CFTC Commission newsletter and receive these reports and particular links to these reports by email. This report is published once a week. It happens on Friday after US markets closing. The report looks something like this. I show it so that you understand what information is available under this report. I would like to note right now that while using these reports in trading practice, we won't rely on this format. Since this report is basically a summary of information on traders' trades over a particular week. That is, the report is published once a week, and this report is a summary over the past week on what happened in the financial markets among market participants that report to the Commodity Futures Trading Commission. The Commodity Futures Trading Commission collects information on traders' trades that are carried out in regulated US markets. We can see statistics on futures and options markets in CFTC reports. In other words, if information, for instance, about gold is published in reports, this is nothing else than a gold futures. These are positions that were opened in the futures market. Can these statistics be applied to over-the-counter markets and spot markets, for example, Forex? The answer to this question is yes. Since financial markets are significantly interrelated now, and if, say, the gold spot market starts to move actively, in most cases the futures market will follow it. If this doesn't happen, then there is an opportunity for arbitration, for the activities of those participants who smooth inefficiency that arises among different financial markets. Therefore, despite the fact that information on futures markets is published in CFTC reports, it can be safely applied to spot markets and other financial markets. The report of the Commission is a table. In the upper left part of this table you can see the name of the financial instrument on which statistics was collected, as well as the name of the exchange where this financial instrument was traded. You can see further several market participants groups. Non-commercial are in general the market participants who can be called speculators. This includes investment funds, bank divisions related to the speculative operations, and other companies that in some way can be qualified as large traders. Commercial is the second group of market participants, which is not directly related to the first group. That is, the logic of their actions, as you will see, is often the opposite to the logic of large speculators' action. So, commercial are those market participants who sell during the market rise and buy during its decline. Most often, this includes those participants who hedge their risks associated with doing business in the real economy. They are hedgers and other large players with a similar pattern of behavior. I will tell you about each of these groups in detail later. In addition, we can see positions of small traders in this report. Small traders refer to non-reportable positions. This is the rightmost column, and as you have already noticed, we can see long and short positions for each of the groups. Please note that in each particular column we can see positions that are open. That is, if we see long, it means that at a given point of time, the time for collecting statistics on large market participants' trades, 39,049 contracts for the purchase were opened by professional speculators. At the same time, 15,954 contracts for the sale were opened, long futures and short futures. That is, these are buying and selling positions respectively. We can see the same for the commercial group, which, by the way, is often called hedgers. I will call it hedgers. We can see the same for private traders, for small market participants. If only one CFTC report was available, let's say a summary of large market participants' trades within one specific week, then this information would be of little interest for us, since we would only see the position of market participants at a particular point of time, namely the number of buying positions which were opened last week. But for this information to make sense, we need to see the dynamics of changes in the large participants' trades during a specific period of time. And naturally, the more such periods we see, the better for us. In most cases, we will see information about major players' trades over the past 3-4 months. And that's more than enough to understand what's going on in the market at the moment and whether the prevailing trend on the daily time frame corresponds or not to the opinion of large speculators. We have seen that two key groups of participants appear in the reports of large traders' trades. These are professional speculators, large speculators, that is, non-commercial group. This group also includes investment funds, hedge funds, speculators. And the next group is hedgers. Hedgers are those participants whose logic is opposite to the logic of large speculators' conduct in the market. Both large speculators and hedgers are two groups that are of great interest for us. As you can see, small traders also appear as a separate group in this report, but basically we won't be interested in them, since small traders are mostly unpredictable. If you look at their logic of decision-making in different situations, then you will see that their actions quite often differ from the logic large speculators follow.